All right, so we're going to come back in a few minutes to this notion of decision criteria. Let's move to what I refer to as a multi-columnar valuation structure. I'll show it to you here, and then we're going to move to the Mira-Dravana case. When I say multi-columnar, I'm showing you everything I possibly can here so I can see exactly how this valuation is coming together. I've got every one of my periods and their years. I'm calling them whatever their calendar year is, just for informational purposes. And in this case, I'm saying that the cash flow I'm wanting to assess for my value is free cash flow. Not EBIT, not profit, but free cash flow. So a very particular form of cash flow. And in fact, it happens to be the form of cash flow that all investors salivate over. Okay? In a simplistic world, this might also be referred to as seller's discretionary earnings, or SDE. And SDE is simply a simplified free cash flow. It's trying to get the same notions. Well, in this case, I have my cash flows starting year one. So the first year after my base year of $1.95, and then $2.14, and so on, all the way through the first year after my explicitly forecasted periods. We're going to talk about explicit and continuation in a minute, but I'm expressly or explicitly forecasting cash flows for years 2020 through year 2024. And you're going to see in a few moments that I used a growth rate, I think it was 8.6%, something like that, to get here. And you'll see next week how we forecast these cash flows. But we're just going to accept I have forecast them. We can believe them. In this next column, I take the present value of the free cash flow. So what have I done? I've taken this free cash flow and divided it by 1 plus the discount rate, in this case, 16.95%, to the power of time, in this case, 1. And it gave me 166. And the next year, I take the 214 divided by 1.1695 to the power of 2, and so on for each of these years, for each year through my explicitly forecasted or expressly forecasted cash flow period. And in this column, I'm simply running a total on them. This one, whoops, plus this one equals this one, plus this one equals this one, and so on. Okay? Such that this number here is the sum of the present value of my discounted cash flows. And so I put it here as the present value of my discounted free cash flows. And then I have this continuing value thing, which we're going to deal with this term a bunch of times. And when we start to articulate this term in time sequence, it will be the most counterintuitive part of this course. You'll have the hardest time wrapping your head around this you will anything else in the course, I think. Nate, you've been through some of this with me before. Would you agree with that?
I would, yeah. It gets confusing.
It's very confusing. It's counterintuitive until you get it, and then you'll never forget it. Okay? Mm-hmm. So think about continuing value for a moment as though it's some terminal value. So it's a value that I'm going to get at the end of this, no different than that $500 terminal value was that we had plugged into, I think it was this scenario where we gave it the extra $500. We thought we could sell this off for $500 at the end of the 5th year. And notice I added that to the cash flow for the 5th year. Well, how do we correlate this? I created this continuing value, and now I'm going to take a present value of it. And I take the present value by discounting it back to that 5th year, because remember that when we used the Gordon growth model construction a few minutes ago, let me pull it back up. Some value at time 0 is a function of the cash flow as of the next year. So this continuing value that I'm giving us here is working off of the Gordon growth model construction. Now that happens to be unique to this type of valuation form, and we'll deal with different valuation model forms in the coming weeks. I don't want you to worry too much about that. I just want you to think there is a value that we're going to get in the future I'm calling it a continuing value at the moment. It might be a salvage value. It may be a predetermined sale value. It may be just what we think we can sell it for, but it's based upon our best WAG, okay? But if that number happens in the future, I've got to discount it back to today. And when I discount it back, because I'm adding present values and present values together, when I discount it back, I'm then going to take whatever this number is, 20.2, and divide it by 1.1695 to the power of 5. It gives me its present value, and the present value of the free cash flow, and the present value of the continuing value give me the present value. Let's look at the spreadsheet so you can see this functioning, and we'll run through those numbers again. So here, this, by the way, is your Excel assignment number 2. And when you look at the Excel assignment number 2, all of these values are simply being carried over or original inputs. So here I've got a carryover. Here's an original input. Here's an original input. I didn't need to. I could have pulled this from the income statement or the financial statements. Here's my free cash flow for my base year. Here's my tax rate. It's carried over. These numbers you should be pretty familiar with by now because you've just been grinding through them. They are my weights. Here are my costs of capital. Here I've allowed them to create my WACC, but I haven't calculated WACC again. So I already calculated WACC once. Why go through that particular brand of hell another time? Just go ahead and take advantage of having done it already. Excuse me, having done it already, and pick it up from right here. So notice that that cell, what is it, K74, and here I'm referencing cell K74. So I'm just bringing it forward. Here I'm saying that I have a proposed value for this investment or potential cost of $20. So I've got the cash flow. Again, I brought it over from I brought it over from another sheet. We'll deal with that sheet next week. I take the present value of it by taking that number, dividing it by 1 plus the discount rate to the power of time. And then I put that number right here in my running total. There was nothing that came before it, so there's nothing to add it to. But in the next period, I take the one from the prior period plus the one from this period, and I add them together as I'm creating this running total here. And my cash flows are coming from some forecast. And you'll see here, I've got my forecasts. Some of you have already started to work through this, some of you have not. And those of you that have are simply working ahead, and you're welcome to do that, although it can be frustrating for you. So that's where I'm getting my cash flows. These are the present values of my cash flows. These are the sum of the present values of my cash flows. I put that sum here. I determine my continuation value, however I've determined it. I take the present value of that, and then those two present values added together give me my present value or my value. This is a multi-columnar valuation structure. I could have done all of this in one cell. Why did I go to all the work of displaying it so outwardly in every component part here? Any ideas at all?
It's nice to be able to double check in case you got the answer wrong, where you might have messed up.
It helps double check, Scott. You're exactly right. It also, I think, just helps visualize how this is coming together. Let me go back to the PowerPoint very briefly. I think I have. No, I don't. Yes, I do. I have it right here, where I say this. No, excuse me. I don't have it on here what I was thinking about. I'll show it to you when we deal with model structures next time. I apologize. So going back to the spreadsheet, I've found out my present value. I could easily now find my net present value simply by taking the present value of my benefits and subtracting from it the present value of my cost. So in this case, if I'm going to have to pay $20 for this investment, it's only going to give me a present value of my future cash flows of $16.62. What do I immediately know about my internal rate of return?
It's going to be less than the discount rate.
Right, because
less than the WACC, the weighted average.
Yeah, my WACC was my discount rate in this case, Jason. So you were exactly right. So in this case, I know that the present value of the benefits is less than the present value of the cost. I'm going to have a negative net present value, right? I don't have to go through a bunch of calculations to do it. I can say this 16.62 minus this, and it's obvious it's going to be negative. Does that mean that I lose money on the investment? It doesn't. In this case, what it means, when the net present value is negative, the internal rate of return is less than the discount rate. Well, we had a pretty healthy discount rate of almost 17%. We can still have some negative net present value and still have a positive internal rate of return. And you can see over here, as you're looking at these values, that in fact we do. I'll show you how we got those in just a moment. But in fact, we have them. We have an internal rate of return of 11.79. That's less than 16.95 by some non-trivial amount. And that's because the 3.38 negative net present value is not a trivial percentage of 20, our cost function. So it all makes intuitive sense once you get used to this. But if we try to find net present value and internal rate of return using Excel, Excel throws us a little bit of a loop. So let's think about this for a moment. I might suppose that using Excel's net present value function, and I'll type the function in here so you can see how it works. I will say equals NPV. In fact, one of you was asking me about this in terms of being able to use an Excel function to calculate the market value of a bond. And we can use the NPV function, or we could use the present value function. Either one is going to get us there. But I'm going to use the net present value function here. And when I do that, I say equal NPV, and I open up a parenthesis. And first thing it wants me to do is give us the rate. That's our discount rate. And then it wants us to tell us what the values are in our stack, if you will, here. So equal net present value. The rate's going to be 16.95. I'll give a comma there. And then I'm going to pick up all of my cash flows, right? I'm going to close the parenthesis. I know this should be negative 3.38. Does anybody want to guess whether it's going to be even close to that? I'm going to tell you it's not going to be close. It's 2.89. Well, how come? Well, what's going on here? Well, a couple of things are going on. One of the things that's going on, you can't really tell unless you read this blog article that tells you how not to use net present value in Excel. When Excel starts counting time, we think it's counting time starting in year 0 for this cost function, right? Excel counts time starting in year 1. It doesn't start at year 0. So it has a structural inconsistency that will mess you up. If you want to read about it, you can read this article, or you can just believe me, or you can go figure it out on your own. It took me about 3 hours to figure it out on my own when I first did it, until I got smart enough to actually go figure out if somebody else had the same problem before as well. You'll see me as I go through some gyrations here, you'll see where we're getting the numbers and why they are what they are. I've got another problem here. Notice that my cash flow in time 5 or 2024, I show it here at 2.85, but I show it at 23.05 here. Well, can it be both? The cash flow, the free cash flow in year 2024 is 2.85. How is it that I'm calling it 23.05 here? Because I went ahead and used the continuing value as though it was another cash flow in that same year. Think back to my PowerPoint when I did this. I added those numbers up. This 500 was a terminal value, a salvage value, a continuing value, however we estimated it, and I have to add it to that year's cash flow. Well, that's what we've done here. We've added that continuing value, which is present as of our year 5. That was times 0 in that construction. And we added it to the cash flow to get a then present value. But it's present then, out 5 years from now, which is why we then discount it using rate and time. Well, here, We simply added those up. And we're going to let the discounting happen from within the Excel function. So I want to replicate this 3.38, which I believe is accurate, and 2.89 is not it. Well, when I did the 2.89, I picked up the cost, I picked up the cash flows, all accurately stated for rate and time and their appropriate years, but it thinks, Excel thinks that this $20 happens at year 1, not at year 0. So I have to outsmart it. And here's how I outsmart it. I'm going, in fact, I'll start here. Now I'll just do it from scratch. Equals net present value. And I'll pick up the rate, the discount rate, whatever that discount rate is. Required return, WACC, interest, I don't care what it is. It's a discount rate. I will then pick up the year starting in year 1 because I know that that's my limitation with Excel. And then I'm going to close the parenthesis. Well, what do I have here? I have the present value of the discounted future cash flows, from which I'm going to subtract the proposed investment to get my net present value. Does that make sense? If you understand its constraint and that it starts counting in time 1, then you can use its constraint. If you don't, then you can't, of course. Well, good. Now I know that I've got a constraint here. It starts counting at time 1, so I should be able to find internal rate of return. I'll do that right here. I'll find internal rate of return equals IRR. That's the function. And I can just put together my values, right? And I'll do it the exact same way. And because I know it starts to count time on year 1, but wait a minute. If I use the same construction, I can't add a cash flow to that. I'm looking for a rate, right? So I can't do it that way. Well, the good news is Excel is smart and stupid at the same time because it doesn't start with year 0 when it does net present value, but it starts at year 0 when it does internal rate of return. I have no idea why it uses 2 different methodologies to get at 2 values that are so completely correlated and used right alongside each other in finance commonly and consistently. Internal rate of return, you literally just say equal IRR and then pick up the cash flows, which is why I went ahead and did this whole column the way I did. Net present value, you have to outsmart it a little bit. And once you've learned how to do these, it's your new best friend. Any questions about where we've gone here? Okay, so let's come back to the PowerPoint for just a couple of minutes. I'm not going to take you much further tonight. I've shown you this, this is for Mira Dravana. We were just looking at it. Here we have it again for Mira Dravana, but this is all of it. In fact, this is exactly what your Excel assignment 2 is going to look like. And then here we have our decision criteria. And I've already talked about these with the exception of modified internal rate of return, the paybacks and the discount and the profit index. These are simple and you'll get them very easily. So let's walk through them. We know present value, we know net present value, we know internal rate of return. But I'm going to tell you something that those of you in finance are going to be surprised by. Internal rate of return is inherently flawed and inaccurate. And yet we use it all the time. Those of you in finance, that's a number or a value or variable you spit out constantly, right? It's wrong. Here's why. The iterative process used in your calculator, in Excel, and in any iterative calculator that I've seen for internal rate of return makes a flawed assumption. And that assumption is that excess cash flows, surplus cash flows, are to be reinvested at whatever this amalgamating or iterating rate of return is. And so it overstates or possibly understates. Let me show you an example. I'm going to calculate modified internal rate of return here for a moment. It's equals to MIRR. And we pick up the values, just like we do for IRR. But then we also tell it a financing rate, and we tell it a reinvestment rate. And I routinely just put those at the same. And it will tell me that my modified internal rate of return isn't 11.79, it's 12.70. Well, that's not that much different than 11.79. Let me show you a more egregious example of this. What if I could get away, instead of paying 20 for this, what if I could get away and pay 2? Somehow my negotiation skills were such that I not only didn't have to pay 20, and I didn't have to pay the 16.62 that at the present value, I was able to negotiate. I bought this thing for 2. Maybe it was a fire sale. Maybe the person selling it was just in desperate need of funds. I came with my wallet full of cash and I bought it for 2. Well, I'm going to have a very substantial net present value, right? Present value of my benefits minus the present value of my cost is going to give me a really nice net present value. And net present value being positive, I know my internal rate of return will be greater than my discount rate. In fact, because this net present value is such a large percentage or a large ratio from my cost, it's going to be a honking internal rate of return. And in fact, it's 124.76%. I think we as investors would recognize that we can every once in a while find screaming deals, right? But would you ever in your right mind suppose that you could reinvest surplus capital at that 125% with any consistency at all? It was serendipitous at best that we got the 125 as an internal rate of return, just because somebody was asleep at the switch when they let me buy this investment with a present value of 16.62, and they let me buy it for 2. That's what set up this incredible internal rate of return. When we assume that we reinvest at the amalgamating or iterating rate that's being calculated here, we run the risk of overstating our internal rate of return. So the modified internal rate of return equation makes the assumption that excess or surplus cash flows are reinvested at the finance or reinvestment rate. That's why it asked us for 2 rates. It wanted a financing rate and it wanted an investment rate. And we could have given it 2 separate ones. For this purpose and what we're doing, I used the same rate. There is an equation for this. It's not a terribly challenging equation, nor will I ask you to read it, memorize it, or use it. To the extent that you ever have to use modified internal rate of return, you'll use it within Excel. I don't believe that there is an HP calculator function that replicates this. It is only an Excel function or the actual math itself, and I won't hold you accountable to the math. Any question about that? Well, I believe the silence means yes, but we don't know what to ask, and we're almost at overload right now, right? Fair enough? Hey, I get it. So let me just very briefly then give you a couple of other things and remind you that the first thing we tend to do when we start is give you guys a chance to ask questions. And then on those weeks in which I think I've gone through some things that are very technical, I sometimes will back up and repeat them before we start to move on. And you can bet that these are some of the things I'm going to back up and repeat next week. Okay, so as we continue down our decision criteria, or the criteria that we might use to help make decisions, the payback period is another one. Well, what is the payback period? It literally is exactly what you think it is. It's the number of periods that it takes for the cash flows to pay back your original investment or your cost. So if our cost was 200 and we're getting cash flows of 20, it's going to take 10 years before we've been paid back. It's as simple as that. Discounted payback is slightly different than that. It now uses the same consideration, the periods till we get our cost paid back, but we take discounted cash flows. Because I know that if I've got a cash flow of 20, I don't get that cash flow for another 2 years, 5 years, 10 years, then it's not worth 20 to me. But my 200 was worth 200 to me, right? So the discounted cash flow is probably a more realistic payback period. And you literally just do a running total of the discounted cash flows, and the period in which they overcome the cost is the discounted payback period. And then finally, a profit index, which really is just a ratio of the discounted benefits to the discounted costs, where we take the present value of the benefits and we divide them by the present value of the costs. And that gives us a ratio. It's an index. So how would we think about using them? I'm telling you that these are all decision criteria. So how do we use a present value as a decision criteria? Emilio, I'll give you a moment to come off of mute. I don't know you at all, other than through this class, but I'm going to make an assumption that if I came to you and had an investment that credibly was going to have a present value of $100 million, can I realistically expect that it would take you a little bit of time to come up with $100 million?
Yeah.
Yeah. In fact, maybe if you're like most of us mortals, you would simply faint rather than try, right? Because for most of us, it's just outside of the realm of reason.
Right.
Okay. So how do we use the present value as a decision criteria? Well, it's our first litmus test. We may not have the cold cranking amps or the checkbook to get there, or the borrowing power to get there. I don't care how good the internal rate of return might be on this or what the net present value would be. If you don't have the amount of money to pay for it, you simply have not started. Okay, that's easy. Net present value and internal rate of return, we can use as a decision criteria. We know that if the net present value is going to be equal to 0, then it means we're getting our discount rate. So if I calculate and find a net present value of less than 0, it tells me I'm not even going to get my discount rate, and I can decide whether I move ahead with the project or not. Is it conceivable that sometimes we will actually move ahead with projects where the net present value is negative?
Yes.
How come?
Well, a lot of things can happen to cash flow over time.
Okay, so maybe we can improve cash flow, right? But let's assume for a second, Emilio, so I think that's you speaking, right?
Yeah.
Let's assume for a minute that the cash flows are exactly what we expected them to be, and that our estimates were really very good. And we really have every reason to believe it's going to be a negative net present value. And we still go ahead and make the investment. What does it mean?
It means that the economic alternative would have been even worse than that one.
Yes, perfect. We went ahead and accepted a slightly lesser rate for our expectation. Yeah, I might want 17%, but if I can't find anything better than 12% in the marketplace around me, and you come to me with something that's going to show me 15%, it's going to give me a negative net present value, but it's still going to be a whole lot better than the 12% I found in anything else that's credible. That's exactly right. Well, modified internal rate of return, we're going to use the same way, but we recognize it's slightly more accurate. The payback periods, discounted or not, may be a function of, yeah, I've got the $100 million, would that I did, of course. I've got the $100 million, but I can't have it sit out there for 12 years. I need to get my money back within 6 years, or I haven't met my other requirements. Maybe I've got some investors that are helping motivate this, or whatever. Maybe I need the money so I can buy that island in the Bahamas that I want to have when I retire, whatever it's going to be. Or I can use the profit index as my decision criteria. I know that if I come up with a profit index that's 1, then I'm good to go. My net present value is 0. I'm earning my discount rate. My profit index is greater than 1. I'm even better off. My profit index is less than 1. Yeah, I may have a little bit more analysis to do, just like when my net present value is less than 0. Any questions? Would you like me to remove the fire hose now?
Rick, can I ask a question, just trying to conceptualize when we go to the free cash flows?
Please.
That start our journey into the net present value. And what is the reasoning behind using the market discount rate, if that's a correct term, and then jumping over into the weighted average cost of capital for our discount rate?
So when you said the difference between using the market discount rate versus the weighted average cost of capital?
Yeah, again, I don't know if the terminology, but when we figure out the free cash flow,
Mm-hmm.
and we use the
well, the discount rate I use is the WACC.
okay.
So you're going to use the discount rate that is consistent with the perspective you have. So in this case, Jason, if we're using WACC as our discount rate, we are looking at this from the perspective of the firm.
Okay.
But let's say, you're not the firm. You don't care what the firm's issues and problems are. That's informed in part based upon the creditworthiness of the firm, right? That's going to help inform their cost of debt. Let's say that you come in here and you recognize that your discount rate, your expected rate of return, your hurdle rate as an investor is 20%. Well, if I've changed that, it's changing all of these because I'm going ahead and discounting at every point that I discount. Everywhere I use a discount rate, including here in the Gordon Growth Model, I'm using what I've got here. Okay? So it's a good question. Your intuition is right. You're going to use the rate that is consistent with the perspective you have as you're approaching this assessment. If you're the investor, you're going to use the investor's rate. If you're the firm, you're going to use the firm's rate. But remember that the firm's rate and the investor's rate should only be meaningfully different if the investor is going to invest something other than their capital. If they're also putting in time and energy in order to, as Emilio or maybe it was Scott that said, to increase cash flows. I know that if I invest in this company, I'm not just giving my $16 million or $20 million. I might do that, but I might take an active role in the company to help increase the revenues and decrease the expenses. Maybe I can decrease its interest expense. Maybe I can decrease its contracts for labor or whatever it happens to be by giving it my relationships, my creditworthiness, whatever I bring to it as an investor. Does that help? Good. Okay, and I just want to go back to that last PowerPoint slide. We've talked through all of this already, but these are some decision criteria rules that I've already articulated to you, and you find them within this last slide. So we've gone through a little bit of stuff, haven't we? Okay, and I'm going to let that be the last of the concepts that we deal with tonight.